So today for the Economics Club, we have Dr. Andrew Lee Smith, who is a senior vice president and economist at the Kansas City Federal Reserve. Dr. Smith is very well published in the Review of Economics and Statistics, the Journal of Money, Credit, and Banking, and Journal of Financial Stability. Do I have all that right, Dr. Smith?
Yes, sir.
I think I've hit most of the high notes there. Um, He'll be talking about the U.S. economic outlook. If you have any questions, please feel free to ask them in the chat. Otherwise, please mute yourself and turn off your videos. And Dr. Smith, I believe, is saving some time for questions after the presentation. So thank you very much, Dr. Smith, for being here. We really appreciate it.
No, absolutely. Thanks for the invitation. I'm excited to be here, and I mean, you're welcome to save your questions for the end, but I also would encourage you to interrupt me with questions. I hope this is a kind of conversational. I mean, I can just talk for 20 minutes straight, but there's going to be a lot of time left over if that happens. I didn't prepare that much material, so I'm kind of hoping we can just have a good conversation. My plan today is just kind of share with you kind of the current outlook for the U.S. economy as it relates to inflation and employment and Fed policy. I will begin with the usual disclaimer you will hear from most Federal Reserve speakers, which is that the views I'm going to share with you today are just my own. These are not official views of the KC Fed or any other part of the Fed system. But with that, let's kick things off. And you can imagine that a lot of the focus of my talk today is going to be on inflation, which obviously remains the primary concern for the economic outlook. So just to highlight the themes I'm going to talk about today, I think it's pretty well known, all of us are experiencing it, that inflation has been stubbornly high over the last few years. And that has led to a swift tightening in monetary policy. Now, one of the more surprising developments over the last year or two after the Fed has started to tighten policy has really been the resiliency that the economy has shown in the face of this tightening. So despite higher interest rates, the economy and the labor market have performed surprisingly well. The good news is that we've had inflation come down despite the strength we've seen in spending and employment. So that's progress towards what the Fed is trying to achieve. But I do think there's kind of a tension here as we go forward, which is, can the economy and the labor market remain as strong as they are, and we still continue to see reductions in inflation all the way down to 2%? And ultimately, I'm going to try to lay out why I think that reaching and sustaining 2% inflation, which is the Federal Reserve's target, will require some further easing in labor market tightness. So let's begin by just reviewing the tightening in monetary policy to date. So since March of 2022, the Federal Reserve has been raising its key interest rate, the federal funds rate, and this is shown in that chart on the left. The pace and the extent to which the Fed has raised interest rates, though, has been historically rapid. And that's illustrated by this gray cloud shading the 4 previous tightening cycles. So that cloud shows you the range at which the Fed has increased rates in the past tightening episodes, say since the 1990s. So over the last 30 years, the Fed has typically increased rates at a more moderate pace. But here the Fed has moved very quickly, raising rates 5 full percentage points in a matter of about 20 months. Now, in addition to higher interest rates to try to slow the economy, the Fed has also been in the process of running down its portfolio of bonds. So during the pandemic, the Fed acquired a lot of Treasury securities and mortgage-backed securities, about $4 trillion worth of assets. And in addition to raising short-term rates, the Fed has been in the process of letting those assets roll off of its balance sheet. And that's another way in which the Fed is trying to slow the economy and tighten financial conditions. Now, we've only used the balance sheet in one other episode, which was the global financial crisis. And so we don't have a lot of familiarity or reference point for how quickly to run down the balance sheet after we've expanded it. But if you compare to the only other time we've shrunk the balance sheet, which is in 2017, we've allowed about $1.1 trillion in assets to roll off the balance sheet versus, say, $430 billion over the same time frame in 2017. So we're proceeding about a little over twice as fast, almost 3 times as fast as we did in that 2017 episode. So all this is to say that in terms of both interest rates and balance sheet reduction, the Fed is moving very quickly to tighten monetary policy. Of course, the goal of this tightening is to bring down inflation, which is unacceptably high. So this chart shows that since the start of policy tightening, we have seen inflation come down. This is the Fed's preferred measure of inflation, the Personal Consumption Expenditures Index. So you might be familiar that there's 2 main measures of inflation in the United States. There's the Consumer Price Index and the Personal Consumption Expenditures Price Index. And the Fed targets the PCE index officially at a rate of about 2%. So since the Fed started tightening in March of 2022, inflation was running close to 7% by that measure. Now it's come all the way down to about 3.5%. So this is progress, and this is promising. So while we all may not feel like inflation's lower because we go to the grocery store and we see much higher prices than we saw before the pandemic, or we go to fill up our gas tank and we're unhappy with the price we're paying at the pump, maybe. There has been progress at the rate at which those prices are increasing, which is, of course, what inflation is measuring. So the question is what's driven the reduction in inflation? Well, this chart tries to show the key drivers of inflation split out between services and goods in the economy, as well as food and energy. So all these bars show the contributions of services, goods, energy, and food to overall inflation. And what we see is that when inflation had peaked in 2022, there was a large contributor from energy prices as oil prices spiked after after Russia invaded Ukraine. And food inflation has been running considerably high as well since the start of the pandemic.
Dr. Smith, could you go back for a second and explain to an undergraduate audience that may be watching how reducing this balance sheet would lead to higher interest rates? Is there a particular way that mechanism works?
Yeah, absolutely. That's a great question. So I'm glad you guys are interrupting me with questions throughout. I hope that continues. So basically, I would think of it this way. Whenever you buy something, and if you buy a lot of something, you can push up the price of it, right? So that's demand shifting out. And so what the Fed did basically is during the pandemic, they bought a lot of assets. They bought treasury bonds, they bought mortgage-backed securities, and that pushed up the price of those assets. Now, prices and yields move inversely to one another. So a higher bond price is equivalent to a lower yield on that bond. And so the Fed pushed up the price when they bought a bunch of these. Now, you have to be a really big buyer to do this in a financial market, right? So, the U.S. Treasury market's like over $25 trillion or so. So it matters that the Fed is holding like $4 trillion, $5 trillion in treasuries. So we're a big buyer. We bought enough of it to move the price. But now that we're shrinking the balance sheet, we're letting the market absorb those treasuries and those mortgage-backed securities. And that's going to have the opposite effect. So when we push up the price, we push down rates. But now we're starting to let those roll off, what should therefore reduce demand, lower the price, and push up interest rates on those bonds. And so it's basically, you can think of the balance sheet as affecting longer term yields, and the federal funds rate is a very short term overnight yield or interest rate. And so together, both these tools are moving rates in the same direction, which is up. I hope that makes some sense. So it's really, you can just think about it as supply and demand. The only thing you have to do in your head is remember that bond prices and yields move opposite of one another. So when we push up the price, we're pushing down the yield. When we push down the price, we're pushing up the yield.
Thank you.
Yeah, no, absolutely. So what's driving the reduction in inflation? Well, it's really driven by energy and goods prices coming down. So those are the orange and the yellow bars in this chart. So energy prices have come down from their peaks after the start of the Ukraine-Russia war, but they're really not falling any longer. They're basically at year-ago levels at this point. And so that means that energy and oil prices are no longer going to be a factor depressing or lowering inflation. And similarly, the progress we've seen on goods prices primarily reflects the healing of supply chains. So this chart shows in green a measure of the supply chain pressures that the New York Fed has put together. And so when that green line, that index gets really high, that's telling you that supply chains are not working very well. So we all saw during the pandemic, it was hard to obtain certain goods. If you wanted to try to buy a bicycle during the pandemic, it was probably on back order. If you wanted to buy a car at the dealership during the pandemic, there were probably few vehicles in the lot. And so those supply chain disruptions that were limiting the supply of goods, those have improved a lot. That green line's come down to basically normal levels. And so with that, we've seen some reduction in goods inflation. And so that's been a key factor lowering overall inflation. So energy and goods prices, have come down. That's a good thing. But we're not going to get a lot more help from goods prices. So supply chains are pretty much healed at this point. Goods inflation is running just a hair above its pre-pandemic levels. But inflation at 3.5% is still running too high relative to the Fed's 2% target. And so what that underscores is there's another key piece of the inflation picture that's really not cooperating yet at this point, and that's services inflation. So this chart shows services inflation excluding energy. Now services is roughly, 2/3 of all consumption in the US, a little over actually, closer to 70%. And so what that means is just arithmetically, if you have services inflation running at 5%, that's 70% of your consumption basket. You're not going to get to 2% inflation. You can see that whenever the US was experiencing 2% inflation prior to the pandemic, we had services inflation running closer to 2 or 3%, about half its current level. So this really tells you, what is the gorilla in the room that we've got to tackle, and it's services inflation. That's going to have to come down if we're going to achieve 2% inflation. Now, the thing about services, it's probably going to be intuitive to you, is that services are just very labor intensive. So the chart on the left shows the share of output accounted for by labor for various sectors of the economy. So for example, in the goods producing sector of the US economy, labor accounts for half of the overall output. So what that means is it takes roughly, equal units of labor and capital to produce a good. But if we look over here on the right, something like education and healthcare services, that labor share is above 80%. What that means is it basically takes 4 parts labor for each part capital to produce a unit of education or healthcare services in the economy. So services, unlike goods, are very labor intensive, and therefore the inflation rate of services is going to be tied very closely to the labor market and the price of that labor. And fundamentally, we just still have a very tight labor market in the United States. So the chart on the right shows the unemployment rate, which is, by far the most widely cited measure of the health of the US labor market. And the unemployment rate is still running below 4%, as it has been for some time now. So the labor market is tight, and that's what's keeping a lot of the pressure on services prices. Now, that tightness of the labor market has been surprising given that we've raised interest rates so much. We thought we would see more loosening in the labor market, perhaps an increase in unemployment. But really, the economy has shown surprising resilience to date, given the tightening we've done of monetary policy. So I like this chart a lot, so I'm going to take a minute to walk through it. But the real takeaway here is that basically the economy has far outperformed consensus forecasts for 2023 growth. So the green bars here represent the forecast for quarterly growth each quarter in 2023, and then the year as a whole, there on the far right for Q4 over Q4. Forecasts that were made in December of 2022. So coming into the year, what did professional forecasters think the economy was going to do? They thought the economy was going to shrink. They thought that in the first 2 quarters of the year, we would basically see negative growth. That's basically the textbook definition of a US recession. So they thought the US economy was going to go into recession, folding basically under the weight of high interest rates. The blue bars show what the economy has actually done. Well, what has actually transpired is that over the first half of the year, the economy grew about 2%. And then we had a blowout growth quarter last quarter. The economy grew almost 5 percentage points in one quarter at the annualized rate. So just to give you some context, average growth in the United States, average real growth, so adjusted for inflation, is about 2%. So we basically had a pretty average first half of the year, and then the economy actually accelerated into the third quarter. So this has been a surprisingly resilient growth picture for the US relative to what was anticipated at the start of the year. Now, again, if you just deconstruct GDP and its drivers, consumption is going to be a huge part of GDP, right? I mean, consumption is going to be 2/3 of GDP, basically. And so for growth to be that strong, we know that consumers are driving a lot of that activity. And you can look at the consumption numbers and you see that consumers are really still spending out there despite high prices and high interest rates. So again, breaking out kind of goods and services in the US economy, the chart on the left shows goods consumption, which during the pandemic moved well above trend. So that was the period when we're all stuck in our house. We can't travel, we can't go out to eat, we can't go to concerts, we can't consume the usual services we consumed. And so we consumed a lot more goods. We ordered more things on Amazon. We ordered different furnishings for our house and so on. And so all that pushed up goods consumption well above trend. And of course, services consumption was well below trend because of the pandemic and the health risks. Well, what economists thought was going to happen is that we would see this rotation back to typical spending patterns. We thought that once the health risk had faded, consumers would rebound back to services and reduce their goods consumption. But really, that's not what we saw. Goods consumption just continued to run above trend, and services has recovered gradually. So we have seen a recovery in services consumption, but it didn't come at the cost of lower goods consumption. Goods consumption has been surprisingly strong. So again, add these two things up, weighted by their share in the economy, and you see that overall consumption is clearly running above trend. And so it's really the strength of consumer spending that's been driving the resilience of the economy. So if you really want to understand why is the US economy so resilient to higher interest rates, you have to understand why consumers keep spending despite high interest rates. And here I think the picture really comes down to household balance sheets. I think one of the more compelling explanations for why the economy has surprised professional forecasters this year is really that we've underestimated the strength of household balance sheets and the role that's playing in driving consumer spending. So the chart on the left here shows net worth per person in the United States. Now, this is an average. Clearly, there's a whole distribution of net worth. I mean, there's a lot of the population has zero net worth. There's people like Jeff Bezos that are far out on the right tail of net worth, right? But just on average, if we look at average net worth, we can see that net worth increased from a little over 400,000 per person in the US to nearly 600,000 per person since the pandemic. Now, net worth has two main components when you look at the flow of funds data. It really is coming down to your value of your investments. So think about retirement accounts and equities. But then a big portion of net worth for a lot of households is their house that they live in, the residence they occupy. And we know that house prices have shot up a lot since the start of the pandemic. So a lot of this net worth in the form of higher house prices is making consumers feel good about their financial picture. And so with higher net worth, you might think that consumers feel less of a need to save because they feel like they have all this equity in their house to fall back on. And that's allowing them to continue to spend and feel good about spending, even as interest rates have increased. Now, I think, a critique of that view would be to say something like, okay, that makes sense, Lee, but, it's really hard to tap the equity in your house with mortgage rates near 8%, right? So if I want to take out a home equity loan, or if I want to refinance my house, I'm facing much higher mortgage rates than I did prior to the pandemic. But the chart on the right shows that it's not just the housing piece, although that's a big part of it, but actually if we look at liquid assets per person, so think about things like deposits in your checking account and deposits in a money market fund, those have increased significantly since the start of the pandemic too. So all the fiscal transfers we did during the pandemic have really shifted household balance sheets in a way that's insulating them from the effects of higher interest rates and allowing them to keep spending. Another factor I think that's dampening the effects of higher interest rates on the economy is that businesses really keep hiring despite expectations for a slowing economy. So I showed you that chart earlier about forecasts for the US economy. That was professional forecasters predicting the economy would shrink in 2023. This chart shows that businesses, so if you just go out and survey small businesses, they'll tell you that they're expecting sales to slow, and they have been expecting sales to slow for much of this year. So that's the blue line there dipping below zero. What's really interesting though is those same businesses tell us that they're actually planning to increase employment despite slower sales. So I think what this reflects is some scarring coming out of the pandemic. So businesses had a real difficulty hiring workers after the pandemic started. And they're kind of scarred by those labor shortages. And so if they expect the downturn in the economy to be short-lived, they're not willing to give up the ground they've made in terms of rebuilding their payrolls and let workers go. Instead, they're actually still hiring people. And so this kind of creates a virtuous cycle in the economy, right? So even if I'm a business, I expect sales to slow, but I don't change my hiring plans, I keep hiring, and all other businesses are doing this, right? Then that means employment gains are strong, wage gains are still strong, and my overall demand as a business is holding up. So I never actually see that slowdown in sales. So you get this very persistent divergence in two theories that are typically highly correlated. Businesses expect sales to slow, but they keep hiring. That's keeping demand and spending in the economy going, and the sales never actually really slow down. So this kind of scarring effect is another factor that's perpetuating economic momentum in the face of higher interest rates. Now, the good news on the labor market has been that we haven't seen, employment growth really slow that much. We haven't seen hiring slow, and businesses haven't been laying off workers. So that's kept employment in pretty good shape. So the chart on the left is a pretty widely watched measure of layoffs. This is data that's released weekly. And it's administrative data at the state level that actually measures in state unemployment offices how many new people came in each week filing unemployment claims for unemployment benefits. So these would be recently laid off workers. And you can see that those weekly unemployment claims have been hovering at pretty low levels for a long time now. So businesses, again, scarred by the pandemic, are not laying off workers. The good news is the labor market's cooling in some other margins, though, and that's taking some pressure off wages, which ultimately we need to happen if we want inflation to come down. So what are some of these other margins that the labor market's cooling? Well, one of the things I would really point out is something called the quits rate, and that's shown in this chart on the right. So this is the share of workers that are voluntarily quitting their job each month. Now, why would you voluntarily quit your job? Well, generally it's going to be tied to the state of the economy, right? So if the economy is really bad and I have a job, I'm probably not going to voluntarily quit. I'm going to be grateful that I'm employed. But if the economy is really good and I see a lot of different job opportunities and there's a lot of wage competition and I feel like my employer isn't really keeping up with with my salary demands or the cost of living, then I might go out and search for another job. And so what we saw over the last couple of years is this quits rate, which doesn't look like a big increase, but these are like all-time high numbers, the quits rate hitting 3%. So that's a very high level of churn in the labor market relative to what the US has typically experienced. That has finally started to come back down, and that's at pre-pandemic levels. So we have less of this churn, less of this poaching and quitting activity, and that's taking some of the pressure off of wages in the economy. The other key piece that has helped bring down wage pressure has been some improvement in labor supply. So during the pandemic, we saw labor supply drop considerably as workers were staying home given the health risks in the economy. But more recently, we've seen that labor supply really come back, especially for prime age workers. This is a promising development in the economy, and I would say one of the more surprising aspects of the pandemic recovery. So if you listen to what economists were thinking coming out of the pandemic, we thought that there would be some real persistent effects on labor supply, especially for even prime age workers. And the reason is because it looked like people had reevaluated their relationship with the labor market. They had reprioritized what was important in their life, more flexibility and leisure and time with family. had become more important relative to, say, your career and your job. And so this could lead to kind of this persistent effect where workers are just working less. Maybe instead of you have a couple and a household, instead of maybe both of them working, only one of them is going to work so that they can spend more time with their family. Also, a lot of the caregiving for elderly coming out of the pandemic. So in addition to childcare, it looked like there was a greater need for elderly caregiving. A lot of people, nursing home employment, for example, has fallen dramatically as that industry has basically shrunk. And so it looked like a lot of that caregiving responsibility is going to fall on the prime age workers. But instead, what we've seen is the prime age participation rate over the last year or so has really shot up and is actually above pre-pandemic levels. A couple months ago, it reached actually an all-time high, basically. So there's a lot of prime age workers working now, and that labor supply has helped resolve some of this supply demand imbalance in the labor market. So, even I think for principal students, hopefully this makes a lot of sense that if you have greater supply, you have lower prices. And so when we're thinking about the labor market, we're thinking of greater supply, the price here is the wage rate, basically. And so that's pushing some downward pressure on wages as supply has increased. And so that's exactly what you see in this chart. So the better balance between demand and supply is easing some of the wage pressures we've seen in the economy. So this is probably my favorite measure of wage growth. One of the things I think that you really learn when you begin to practice, economics as a profession, say, versus in the classroom, is that, measurement is very hard in the economy. And I'm sure you guys have learned about that from Dr. Mattson in terms of monetary aggregates, but I would also say measurement of things like wage growth is very complicated. So whenever we look at aggregate wage dynamics in the economy, you're really getting not just an individual's wage changing, but you're also getting shifts in the composition of labor. So if we see more workers moving to hospitality and leisure from, say, manufacturing is a relatively high-paying job. Hospitality and leisure is a relatively low-paying job. And so if you have this shifting share of workers in industries, these shift shares can distort aggregate wage measures, and it's really not a clean picture of what's happening to each individual worker's wages. Instead, it's this composition and weighting that's changing. And so this is one of my favorite wage measures because it actually is based on interviewing individual workers, and then they aggregate all that up and look at the median or the average wage growth in the economy. And so this controls for that compositional problem. And you can see that wage growth basically hit 7% in 2022, but that's come all the way down to 5%. So that's a promising development. But is 5% wage growth enough to bring about 2% inflation? I would argue no. The reason is because the weight of wage growth is consistent with 2% inflation really hinges on labor productivity. So the way to think about this is, a firm's cost is going to grow at, say, the rate of inflation plus the rate of labor productivity, or minus the rate of labor productivity. So if wages are growing at, say, 5%, labor productivity is growing at 1.5%, what that means is that the productivity adjusted wage that the employer is paying is like 3.5%, 5 minus 1.5. So that's still too high above 2%. So if you want to get to 2% inflation, you really need to see wage growth that's roughly equal to labor productivity plus 2%. So that means we need wage growth in the neighborhood of like 3.5%. So this chart shows labor productivity in the US, a really lackluster pace of productivity growth for, say, the last 40 or 50 years in the US, except for what we saw in the late 90s, where we had kind of the IT boom and that burst of productivity. But we've come off of that, and we're kind of back to this slow pace of labor productivity growing at 1.5%. And what that means is you really need wages growing something like 3.5% if you want to hit 2% inflation. And so you ultimately need to see wage growth come down if you want to hit 2% inflation. And so for wage growth to come down, you really need to see some rebalancing in the labor market between labor supply and labor demand. So we're seeing some signs of that with, say, the quits rate. We're seeing some of that demand pressure fall off. we're seeing some of that labor supply come back. And so these are promising developments that are lowering inflation without raising unemployment. The question is can we continue to see inflation come down? Can we get all the way to say 2% inflation without seeing a large rise in unemployment? That would be historically unusual, but a highly welcome development if that were to be the case. Certainly what we've seen during this tightening cycle has been historically unusual, but a welcome development that we've seen inflation come down so much without unemployment increasing a lot. And that's what's shown on this chart. So this chart shows a scatter basically of inflation and unemployment in the United States over the last 50 years or so. And so each dot here is a quarter in time, and the dot is placed at where inflation was and where unemployment was. And you can kind of think about splitting the economy up into these different quadrants, right? So if you're over here on this northwest quadrant, you have low inflation but high unemployment. That's basically a recession. If you're over here in the southwest quadrant, though, then you have low inflation and low unemployment. That's a very good economy to be in. That's kind of where we were pre-pandemic. You might call that like a Goldilocks economy. Then on this top, in this northeast quadrant, you have stagflation. And so that's a combination of high inflation and high unemployment. We really only saw that, over the last 50 years in, say, the 70s and 80s in the economy. But where we are now is actually at this southeast quadrant, and that's the overheating economy. That's high inflation, low unemployment, a very tight labor market that's pushing up prices and wages. Since we started tightening policy, that's the blue dots here, you can see that inflation's fallen from about 7 to 3.5%. So it's fallen in half. That's great progress. And that's come without really any increase in unemployment to speak of. Very little increase in unemployment. Can that continue? Will we continue to see inflation come down without the unemployment rate shooting up? I think there's reason to be optimistic. I'm going to outline two possible scenarios here as I begin to wrap up the talk. I'm going to outline two possible scenarios as to why that could happen. Really, the first is just that we see a continuation of the trends we've seen so far, which is that the labor market rebalances through margins other than layoffs, and that rebalancing between demand and supply eases wage pressure and brings down inflation. So this chart shows perhaps one of the more popular measures of labor market tightness because it directly measures the ratio between demand and supply in the economy. So this is the ratio of job vacancies to the number of unemployed people. So this ratio hit 2 in March of 2022. It basically is at 1.9. So what that means is there's basically 2 job openings for each single unemployed person in the economy. So literally for every unemployed person, they had their pick of which job they could take. So that's a real imbalance between demand and supply in the labor market. That's a lot of demand and not very much supply. And so that's pushing up wages. What we've seen is this ratio of job vacancies to unemployment has come down a lot, though. It's come all the way down to 1.5. Now, that's probably not where it needs to be. It probably needs to be closer to 1 to be in better balance. But we've seen this rebalancing of the labor market through vacancies, job postings coming down, labor supply increasing, and firms aren't laying off people. And so the unemployment rate is not really increasing. And so you could just see further rebalancing, a continuation basically of this trend, and that could bring about lower inflation without necessarily higher unemployment. The second development that could lead to lower inflation without necessarily higher employment would be an improvement in labor productivity. So I talked a little bit before about how you really, if you want to justify higher wages in the economy and to be consistent with 2% inflation, you need workers to be more productive. You need higher productivity of labor. Now, what would increase labor productivity? Historically, it's been things like innovations in the economy that have changed the way we work. So think of the IT revolution we had, say, in the late 90s or early 2000s. There's a lot of optimism that we could see another burst of productivity, say around artificial intelligence. There's a lot of enthusiasm certainly for that now. While it's really hard to forecast labor productivity, certainly what I could tell you is that if we did see some increase in labor productivity, say through AI or something else, that would be a development that could simultaneously make workers more productive, lower firms' labor costs, bring down inflation, but not necessarily increase unemployment or lead to large layoffs in the economy. So some favorable supply side development basically would be another factor if you saw supply shifting out to the right and increasing, you could bring down inflation without necessarily sacrificing growth or employment. And so I think those are two perhaps optimistic but realistic scenarios where you could see inflation continue to come down without seeing an increase in unemployment or large layoffs. And so just to kind of summarize here where we are in the economy, what have I talked about today? So despite what has been a historically swift increase in interest rates, labor markets have remained tight and inflation remains too high to this point. But the good news is the direction of travel has been promising. Inflation is falling, labor market tightness is easing, the quits rate is coming down, the ratio of vacancies to unemployed is coming down without large increases in layoffs or unemployment. Now the question is, can we get all the way to 2% though? So we're not done yet, we're at 3.5, the Fed's target is 2. So we have more work to do on inflation, and that's likely to require some further easing of labor market tightness. Remember where that inflation is located in the economy, it's in the service sector. And those services are labor intensive. So you need the price of labor to come down basically if you're going to bring down inflation. And so you're going to need to receive some rebalancing of labor demand and labor supply. Now that may not require large layoffs though, especially if you see supply side developments easing inflation, perhaps through productivity. Although historical trends are not all that encouraging, again, it's hard to forecast productivity. So if you saw this big burst of productivity in the economy, that would be a very welcome disinflation, bring inflation down without slowing economic growth. So with that, that's all the slides I have prepared. But hopefully you guys have a lot of questions or just want to have a good discussion about the economy. Or I'm happy to talk about other things if you want to talk about working at the Fed, what that's like. So I'll just kind of open up the floor.
Thank you, Dr. Smith. Does anyone have any questions?
Can I jump in and ask one?
Absolutely.
Yeah, this is on, we're kind of talking about this topic, so I'd just be interested to hear maybe what you have to just generally say. Can you maybe just briefly discuss what the role of the regional banks are in terms of both keeping an eye on like local conditions, but then also how do they contribute to the larger national monetary policy at large? How do you guys do both of those things?
That's a great question. I mean, it really goes at the heart of the Fed system, the way it's structured, the kind of this federalist structure where you have regional Fed banks that feed in though to a national conversation. So the way I think about it is it's really the role of the regional Fed to do two things. It's our job to represent the FOMC and national monetary policy to our district, to our constituents, so they can understand, what is U.S. monetary policy doing and why. But it's also the job to represent the district to the FOMC and to that national conversation. And so it is two-way. And so it's interactions just like this, for example, where we're going out, we're speaking to civic groups, we're speaking to community groups. We have a lot of advisory councils at the regional Fed level. So these are, economic development councils, community development councils, economic development, you name it. We have a lot of touch bases with different industries and labor groups basically in the region. And they're giving us information on what they're seeing in their communities and in their lines of business. Are they hiring? How hard is it to hire? What are some of the challenges they're experiencing as consumers? And so we get a lot of that input. We take all that, and that's really part of our pre-FOMC process. So before each FOMC meeting, so sorry, I shouldn't say FOMC for those in the room. So Federal Open Market Committee, that's the chief monetary policy making body of the Federal Reserve. That's the committee that votes on setting interest rates. And each of the regional banks has a seat at that table. The president of the regional bank sits at that table every 6 to 8 weeks with J-PAL and all the governors. And they sit around and they discuss the economy, they discuss what policy should do with interest rates, and then they take a vote. And so every 6 to 8 weeks, our president goes to DC and sits at that table. And so that's their chance to represent the district and to say, this is what I'm seeing in my region. I'm seeing a strong labor market, but I'm seeing signs that some of these imbalances in the labor market are improving. Firms that were having to do mid-year wage adjustments a couple of years ago, they aren't having to do that as much. So then maybe that's an early indicator that some of these wage pressures are going to start to come off. And so they bring that information to the FOMC, to DC every 6 to 8 weeks. But then they're sitting there and they're part of that conversation. So they understand what is the national picture, what's the rationale for the national policy that's being made, and they can bring that back to the district. So then when the president goes out and speaks to groups, they can then inform the region of what they're, this is why policy is doing this, and this is what we're seeing. And so it is a two-way conversation. The regional banks are really instrumental in that two-way conversation, though. They're the ones in the communities, I would say. It's much less common for the chair and the governors in DC. They just don't interact as much with the regional groups. So hopefully that gives you some idea.
Well, thank you. That's a great answer. And I just want to say that's a fantastic presentation overall.
Hey, thank you.
Lee, in one of your previous slides, you talk about how the forecasts, the economic forecasts are very different from what the small business owners were feeling and kind of forecasting for themselves. What did we as forecasters get wrong? Are we looking too much at the yield spread? Are we looking too much at equity prices? Why did we as forecasters say GDP was going to contract, and then small businesses see it was going to expand and behave accordingly?
Well, I mean, I guess I would say there's less of a disconnect between what forecasters expected and what small businesses expect. I think everybody expected much sharper slowing in the economy from high interest rates. So, I mean, when you take interest rates from near zero to over 5 percentage points, now remember in the last tightening cycle, the last time the Fed raised interest rates in 2019, rates crested like near 3%. So this is a much higher level of interest rates than the economy has experienced in a long time. And that's from a very low base. So rates shot up rapidly. I think everyone expected the economy would slow sharply. Instead, the economy has been chugging along. So that's kind of what this shows, is that relative to forecast, the economy has really outperformed. And then if you go to businesses, they also expected the economy to slow. So the blue line here shows that if you look at the fraction of businesses expecting sales to slow, more expected them to slow than to increase. And so there was this belief that the economy would slow, but instead the economy has really kept chugging along. And I'm kind of pinning some of this on businesses themselves, though, to say, yeah, you're forecasting your sales to slow, but you've kept hiring despite that. And that's going to lead to this very persistent divergence in your forecast and what actually happens.
Yeah. Thank you.
Yeah, no, good question.
I think Dr. Stitzel, you're in the room right now. Did you have a question you wanted to ask?
Yeah, I can.
First of all, Dr. Smith, can you hear Dr. Stitzel?
Can you hear me?
Yeah, it's a little faint, but I can hear you, I think. Yeah.
Well, I was just going to ask, we had Alex Salter up here about a month ago, and he was writing in, I think, AEIR, that even though inflation was still 3%, that he was advising the Fed to stop raising interest rates. But you seem to be sort of the opposite opinion, that we're not down to 2%, so we're gonna have to raise rates. What's your take on that? And just kind of briefly talk about why other economists that interested in monetary policy might have differing opinions.
Yeah, that's a really great question. I mean, I think, I have my view, right, which is that I think that the 2% target is something that, to be an effective target, you have to be committed to achieving it. Otherwise, it's a target in name only kind of thing, and it's not clear that it's actually going to do its job of anchoring expectations for inflation, which is the role of that 2% target. So I think you have to be fully committed to achieving 2% inflation. You have to act accordingly. Where I think there's a bit of a disconnect and some room for debate or conversation is to say, once we get inflation down to say 3%, which we're not really there yet, we're at 3.5%, but let's say we get it down to 3% or so, and unemployment's starting to come up, if you feel like you're going to have to sacrifice 1 or 2 percentage points on unemployment to achieve that last mile of inflation reduction, is that worth it to you as a policymaker? And that's really a question that's a normative value judgment that comes down of how you weight your two mandates. So remember that the Federal Reserve has 2 mandates from Congress. Those mandates are price stability and maximum sustainable employment. So what we want is we want low inflation and we want low unemployment. But sometimes those objectives come into conflict with one another. And so you could have high inflation and high unemployment. So you're missing on both. The inflation side would tell you you need to tighten policy. The unemployment side would tell you you need to ease policy. And so when you have these conflicts between your objectives, it comes down to how you weight the two objectives. Do you put more weight on the unemployment mandate or the inflation mandate? And what I would argue is that, again, we have seen the benefits of having low and stable inflation in the United States for the last 30 years before the pandemic. We were able to have very long economic expansions. The labor market was functioning very well prior to the pandemic, even with low inflation. And so those are the types of outcomes that I think you benefit from when inflation expectations are well anchored at 2%. And so the threat of losing that anchor, I think, has some long run economic costs for the economy. And that's where it's my view that I don't think those costs are basically worth the benefits of having slightly lower unemployment for a year or two. I would be willing to trade off a little bit higher unemployment if I thought it was temporary for the benefits that low inflation can bring about. But again, when your two mandates you're given are in conflict with one another, it's going to come down to a value and a normative judgment of how you weight your mandate. So there's plenty of scope for reasonable people to disagree. You know, that's another great part, I think, of the regional Fed structure, right? Is that you get this real diversity of opinions at the table in Washington, D.C. Whenever the presidents and the governors sit around, you get opinions about people, you know, that are seeing things in their district where they're seeing the harmful effects of inflation. You have other districts where maybe they're hearing from community groups that the labor market isn't performing the way it should. And so you get all this information and these diverse opinions and views coming to the table, and all that's laid out in the open for you know, the debate and the consideration of what policymakers should do. But you know, policymaking is hard inherently, and there's not always a slam dunk answer. You know, I kind of joke around with people that being a policy advisor the last couple of years has been very easy. With inflation as high as it is, it's been easy to argue, yeah, we need to tighten monetary policy. But we're getting to the point where there's going to be a lot harder decisions and conversations, and you're probably going to see more disagreements, I think, on the FOMC.
Do you guys keep the game theorists in the basement?
Well, I mean, you know, I think that game theory has had more of a role probably in macro over the last 10 or 15 years than it had before. You know, I think there's game theory elements to some of the labor market dynamics I was talking about. So one thing we've talked about a bit is the possibility that you kind of have this herding mentality in the labor market. You know, if nobody else is laying off workers, you don't want to be the one firm that's laying off people, right? And so there is kind of this coordination element that I think does bring aspects of game theory to how you think about the economic outlook. And it suggests that, well, nobody's laying off now. If you saw a few firms start to lay off, everybody would be kind of comfortable laying off people. And I think you kind of saw this play out with the tech layoffs we saw earlier this year, where you had an industry that had really hired up a lot during the pandemic. And then once a couple of firms announced they were doing layoffs, it felt like every tech company was laying off some people. And so you kind of get these herd mentalities and these coordination mentality between firms that does affect, I think, aggregate outcomes. So I definitely think there's scope for game theory to inform, you know, how we think about the aggregate economy.
That's good. One last, I only want one last question, and maybe just, have you ever been to one of the FOMC meetings in DC?
Yes, no, I've had the privilege to go to a few. It's definitely, yeah, it's definitely kind of a bucket list type thing. I think if you work in monetary policy to be able to sit in that room and hear that conversation and see that meeting proceed. So it's a very cool experience, and I'm fortunate that I've had that opportunity. So.
All right. Unless anyone has a last question, I think that wraps it up for this meeting of the Economics Club at West Texas A&M. Thank you, Dr. Lee Smith, for providing us with your insights and with your presentation today. We really appreciate it. And I think I will stop the recording here. So let me go ahead and do that.